Happy Friday. This is Jean Joe, broker and owner of Perisson Real Estate, and I'm back with another edition of Perisson Pulse. Before I go into today's topic, I just wanted to remind you of our upcoming seminar next Wednesday, March 13th, called Retirement and Relocation Strategies. This will be at 7 p.m. at the Millbrae Recreation Center, and we'll be joined by Ron Ricard of IPX 1031 and Joe Daly, my favorite CPA, as they cover the different aspects of planning for retirement as it pertains to real estate. If you're interested in attending, be sure to let me know as soon as possible since seats are limited. For today, I'll be sharing with you a video from my recent networking group session where we learned about alternative loan options or non-QM loans. The term non-QM refers to non-qualifying mortgages, and this has to do with folks who might not qualify for a traditional mortgage, but otherwise have great assets or income. Elsie Wu and Eric Sitt from Abundance 99, whom I consider to be good friends, spoke with a group of us about these options and how they may be used to help our clients. So I hope you enjoy.
Well, thank you, Jean, very much for the opportunity. And also thank you to everyone on this roundtable today to hear a little presentation about the specialty loan. And more, we are seeing, I think because of the market condition and because of the buyer demographics today, we are definitely seeing more and more special needs. And I don't know how much of that is because we're known to address these special needs, or really the entire market is shifting so that the big banks, do the conventional loans, and then the independent mortgage brokers do the specialty loans. So at the end of the day, through Eric's effort, we actually have relationship with around 30 different wholesale lenders. And the reason we choose to work with so many wholesale lenders is because every single one of them have their own niches and their underwriting overlays. And then they all change their interest rate at different speed. So some of them, the bigger ones, may change their interest rate 3 times a day. Some of them may change it every 2 weeks. So when the rates are very volatile, we can potentially get our borrowers a better interest rate or lower fees by working with one lender versus the other. So what we try to do is then be that one-stop shop for our real estate broker partners and then for our borrowers as well. So a little background about non-QM. About QM. So after the Great Recession, there was a lot of regulations, and they had, I think, 3 years working on these regulations, and they also put together Financial Protection Bureau (CFPB) for the oversight of these and the enforcement of these regulations. So, it got to a point, for example, you all know the loan estimates, the LE, that's part of your standard loan disclosure package. They were telling us what fund size to use. They were telling us how to organize the items in the loan estimates. And they were telling us, where you can round off and where you cannot have decimal points. Okay, this is the level of detail they were telling us. But at the end of the day, what they're focused on is this ability to repay and very clear and easy to understand loan disclosures so that home buyers, if they do have the time, they can do apple to apple comparison. So this is why they have all of us do this APR calculation and then the TIP calculation as part of the standard disclosure. And we are not allowed to deviate from that format. The big lenders don't deviate. The little lenders, none of us deviate. And all of us to make sure that we don't face very stiff penalties. And they even set up a consumer hotline so that if someone does deviate, consumers can actually call the hotline to file complaints. And we as lenders actually have to respond to those complaints as CFPB calls us. And we have also been warned by the private lender industry attorneys that these enforcement officers, they're very vigilant about following up on complaints. And then if they find one error, they may potentially bring in other regulatory agencies and investigations to look at your entire business. So this is why the big banks, the little banks, everybody is so concerned about following the regulations, dotting the I's. They don't want to bend the rules. If they're not sure about the rules, they don't want to bend anything. So then there are Wall Street firms that says, hey, we don't care about reselling the loans to Fannie Freddie or private hedge funds. They don't care about reselling the loans to Fannie or Freddie, or some banks. They may say, hey, we are perfectly happy to have our own portfolio of loans that we don't resell to Fannie Freddie. Therefore, we want to have other guidelines, and that's where you'll see some of these non-QM loans in the advertising, probably in your spam folders quite a bit. So Eric, would you take over for QM fails?
Sure. So as with any regulations, and then which is kind of like a pendulum swing before the great financial crisis, and then there's a saying that you can fork a window, you get a loan. And now that after the 2008, the pendulum swings the other way. And so it's all good intentions, but they have unintended consequences. And then it affects real life clients and their situation, their ability to purchase a home, get a loan, and then achieve their financial goals. And so we continuously talk to clients who are in situations where the QMs does not allow them to get a loan, and then allow them to basically invest in real estate or purchase a home. So some of these examples, you would think that, hey, these people look financially pretty strong, and then but according to the rules, and then they are not eligible for loans, and primarily because they cannot demonstrate regular income, continuous income history, and all that.
So all these 5 examples are actual real world examples. Some recent, some in the last 3-4 months, where people came to us and they just cannot qualify for a conventional loan. And these range from, as Eric was talking about, people who retired early from tech, from biotech, from fintech, lots of money in their bank accounts, but they can't qualify for a loan because they don't have current income. And then, or people who have retired and have not started drawing on their retirement accounts, they don't have income to buy. Real estate brokers or other business owners who have inconsistent commission income. So when if you're trying to get a QM loan, you need to have income that's steady and increasing, right? So if you have a year of declining income because the interest rate went up, then you can qualify for a loan anyway. For a conventional loan, when that happens. Real estate investors with more than 10 residential properties and loans on their credit report, they can't get a loan. And I'll use the 5th example. My parents with a free and clear home, they cannot get a QM loan to cover caregiving expenses, and they can't qualify for a reverse mortgage because they have moved in with us, so their home is now vacant. So now we're trying to figure out how we can help them as well. So this is all where QM failed. Like I said, because the pendulum swung all the way to the other end. So even some of the people with excellent credit, excellent income, or lots of net worth, they can get a loan. So the federal government, of course, defined the QM standards, and then the federal government has different bars that they set for the non-QM. So non-QM basically says, okay, they cannot easily sell to Fannie Freddie, and then they're not presumed to be innocent, okay? So you have to demonstrate that you're innocent by doing the same disclosures and then actually potentially more disclosures. But some of the things that they allow, the regulation allow the non-QM lenders to do are, for example, instead of 24 months of income, they can do 12 months of income. And if your income is not a W-2, potentially we can look at bank statements. So for example, if you're in the real estate broker industry, if you're a real estate broker and you haven't done your taxes, but you can show the last 2 years of bank statements, then they will total let's say it's last 12 months or 24 months of business bank statements. Then they will look at your total deposits. They will apply some kind of a ratio to figure out of expense ratio, and then they will use the remaining balance as your income, and they use that income to qualify you based on the debt to income ratio that they have set for that type of loan. Similarly, with profit and loss, if you don't have W-2 income, if you don't have the documentation that a QM lender typically requires, they can look at profit and loss. They also allow us to use brokerage accounts and retirement accounts to qualify. So let's say you have $5 million in the brokerage account. They will allow, for example, they will apply 75, multiply that by 75%, assuming the market is volatile, so that they need a 25% cushion. And then they'll take the remaining 75% of your brokerage account balance, and then they will divide that, for example, over 20 years or over 10 years to determine how much you can potentially use as income to qualify to pay for the loan based on their debt to income ratio. And then there are also non-QM lenders that will look at a potential rental property and do a market survey of where the rental rates are in that for the property you're looking to buy. And they will give you loan based on their debt service coverage ratio. If you meet, for example, if your projected rent is $6,000 a month, they will look at how much rent you can qualify. Sorry, how much loan you can qualify based on that $6,000 a month rental income. So there are a lot of different niches, a lot of different overlays that these non-QM, typically these are Wall Street lenders, would apply to the loan so that they can offer more products to the people who don't qualify based on the conventional QM underwriting. But the key thing to remember is that if these are consumer loans, they still have the same disclosure requirements, meaning they still have the 4-day waiting periods after the loan estimate is out, 3-day waiting period after the closing disclosures are out, and then if it's a cash out refinance from a primary residence, then they still have to have the 3-day right of rescission. Okay, so these are just very high level differences between QM versus non-QM, qualified versus non-qualified. So then the next slide, we talk about some of the solutions that you should keep in mind as you talk to your sellers and home buyer clients. So on the leftmost column, we have the challenges that you are likely to hear about. We have the assets that that other lenders, QM lenders, don't generally consider. And then the solutions that may help these clients buy their next home. So Eric, I will cover this slide and I'll have you cover the next 3 slides if your echo is okay, is gone. So for example, we talked about this retired couple who have not started drawing on their retirement. They wanted to buy a new home closer to their daughter. They had $3 million in their Mountain View home free and clear. They had $2 million in their brokerage accounts, at least $2 million, but they have no income. So in something like that, they can either use the owner-occupied bridge loan to buy the new home and then sell the existing home, or they can use their brokerage account because they're already retired. They will have a more relaxed formula to look at their brokerage account balance, divide that over a certain number of years to determine how much mortgage they can have, and they can potentially use that to qualify to buy a new home as well. And that loan qualification, that loan program is called asset depletion. So Eric will go into more details of asset depletion and how that works in the real world. And then we talked about self-employed startup founders. We have we have borrowers like that often. People who've done well, who decided to go independent, start up their own company. They used to get loans from First Republic Bank, and now that First Republic Bank is no more, they're looking for other lenders. And now these, they have steady or growing business revenue. They may have, they may be the first or second or third round of funding, but because they own their company, they cannot get a conventional loan. So then we can do the alt-doc loans for them. If they have too many rental properties, they want to buy more. That's the third row. We have debt service coverage ratio loans for them. And for people who have really low mortgage on their existing home and they want to keep that really low mortgage at 2.5, 3% interest rate for as a rental property, and they want to move into their new home. They don't want to sell the new home. Then they cannot. That's right. They don't want to sell the existing home. Oops. Sorry, I messed up. Okay, so that fourth row, the bottom row, if they want to buy a new home, they don't want to sell their existing home. Instead, they want to keep their existing home as a rental. Then again, we can look at asset depletion as a loan program for them. So hopefully this gives you some ideas on things that you may hear from your clients that may be a trigger for you of the loan types that they may qualify for. So they just because they have these challenges does not mean that they're a default no for loan qualification.
So for asset depletions, one thing that we want to draw your attention on is that the assets actually used to qualify for the loan. There's no restrictions after the clients obtain the loan, and then you're not required to draw. You're not required to actually deplete it on a schedule. You're not required to maintain a certain balance. The client is free to do as what they want. It's just another way of showing that, hey, and I have enough financial means to cover my housing cost and the other obligations. And that's really what it is. And then the lender would happily lend it to you and resell it to Wall Street investors for higher percentage. So if you want to get an idea of how high it is, I just check and then compare with the conventional loans. Is about 0.75% higher. And then this is using an example of $2 million versus $1.5 million loan, so 75% loan to value. And then it's for people who, like we've said, a lot of assets, they can potentially buy their home all cash, but that means that they have to liquidate their assets. And then often means that significant capital gains. So it really doesn't make sense for them to sell the assets, pay 30-40%, and then come back with the after-tax money to do an all cash. So this is potentially cheaper, even though it's a little bit higher in interest than conventional loan. And the good thing is that for people who have limited or insufficient, quote unquote, regular income, the lender won't even consider it if you have enough assets. And then, but it does actually do the debt to income ratio. So it would actually include all obligations. So the process actually, in some cases, simpler than a conventional loan. What the lender would do is just look at all the assets that you have, what's in your bank account, which is liquid, brokerage is near liquid. And then they would even allow you to include retirements. You don't have to be at retirement age to have some of these lenders include your retirement account. They would apply different percentage and come up with a lump sum. So that, and then from there, they would try to derive the income. The way they derive an income is as if you are actually selling a little bit of it, and then over a period of anywhere from 60 to 84 months, well, basically 5 to 7 years. That's typically the range that they use. So basically, divide the whole thing by 60 to 84 months. Then you have a monthly amount. That's what they consider income for this loan purpose. And then if you have enough to typically meet two times the obligations, then they would approve you for the loan, and then you're good to go. And because it doesn't require a lot of income, it really sometimes makes things actually simpler, because all the client is doing is saying that, okay, I give you 3 to 6 months of all the statements, and then after that, that's about it. Yeah.
So on this slide, asset depletion, if you're working with sellers or buyers actually, who mentioned that they have a stock portfolio with Goldman Sachs, with Morgan Stanley, chances are they are asset rich. Chances are they already have access to those brokerage firms' asset depletion program. So always suggest that they talk to those sources first, because other lenders, outside lenders it's really hard for them to compete with that relationship discount. It's where they generally don't have enough. They need us to combine multiple assets to help them qualify. That's where we mortgage brokers can make the most difference.
Another example of non-QM is for the business owners. Like the earlier slide, we talk about a very busy real estate agent who just hate to do taxes. So he would stand in his estimated taxes, but he doesn't, for some reason, he doesn't want to file them. And then, so in that case, if he goes to a conventional lender, says that, hey, I have nothing to go with. And then you may tell me you're very successful, but I have no way from your tax to figure it out. And then we also have other business owners who's very good at optimizing their tax. So they show very little taxable income. And then, but in fact, they're actually doing quite well. And so for these people, and also there's another class of people where they are moving from W-2 to 1099. They don't quite have the history. They are in the same line of work. And so again, for them, conventional lender said that no can do. So in that case, what this type of loan is allows you to do is that the lender says that, hey, okay, I understand your situations. I have other ways to show that you actually make enough money to qualify for the loan. Okay, show me your bank statements. I'll take all your bank statements and figure out the business deposits, and then all your commission checks, and then checks from the clients. And then I will deduct some expenses, say 50%, and which is pretty reasonable. Then if you still have enough income to cover your obligation, typically, again, it's about 2 times the obligations, and then which is similar to the conventional loan, then I feel comfortable lending you the loan. And then it would be at a slightly higher rate. And then that higher rate is similar to the asset depletion, which is about 0.75% higher for the same type of loan scenario. And then in that case, you don't have to worry about tax return. You don't have W-2, that's fine. You can give me 1099. You don't have to go by 2 years because we are not as strict as QM. And then some lender, they will even take profit and loss statements, but it has to be certified CPA. You cannot just make up your own profit and loss statements. And then, so in this case, it goes through, the lender generally goes through the calculations. And then in this case, it's also somewhat, this type of loan may require a little bit more explanation, so probably not as straightforward as the asset depletions. And then, but generally the timeline is very similar to the conventional loan. So that's next slide. So the next one is the, which is also very popular, is the DSCR. It stands for debt service coverage ratio. The difference in this case is that it doesn't require any income at all. So what this is trying to do is just say that the lender is just looking at the rental property and then trying to decide, can it stand on its own? Stand on its own, meaning that do you have enough rental property to pay for all the carrying cost? Or how much of the carrying cost are you paying for? And so that what they would do is they can actually use short-term or long-term rental income. The property can be, they're flexible in the sense that the property can be unleased. So what we would do is do an appraisal for market rent. If it's short-term, they would give you 75% of the market rent as potential income. If it's long-term, they give you 100%. And then,
sorry, Eric, what do you mean by short-term versus long-term? You're talking about Airbnb?
Short-term Airbnb. If you declare that your intention is rent it out as Airbnb, they actually is pretty conservative. They would take the regular rent and then just give you a discounted amount as income. And because they want to be able to protect themselves when they give you the loan, that you actually have enough incomes to cover the expenses. And then what they would do is that use that to compare against the housing expenses, which is really mortgage, tax, and insurance. And that would come up with a number. That's where the coverage ratio comes from. It can ideally cover 100%, then the lender is very happy. And then in many cases in the Bay Area, generally 75% or maybe even less. And so from there, they would decide that if you have enough down payments, for example, if your coverage ratio is 75%, typically they would ask you, they give you up to maybe 60% loan to value. And then if it's 100%, they can go up to about 75% loan to value. You will end up paying about 1% higher than conventional loan if you qualify with your income. And it addresses a few restrictions, which is that Fannie and Freddie has a limit on the number of finance properties. Like our one of our hard money loan clients, he has dozens of properties in the East Space. They all cash flowing nicely, but he's beyond the point where he can get a conventional loan. No conventional lender will loan it to him. He simply has too many financed properties. So this one actually allows him to do that. And then with so many property, his income, even though he's run a successful business, it's too stretched to make this happen. And then the loan itself gets very, very complicated with so many properties. And so the other thing that I want to mention that this loan is actually, in some sense, a little bit easier to do. Essentially, look at the property, do an appraisal, and then do an appraisal of the property value of the rent, market rent. And then the lender pretty much can make a decisions if there's no other issue with the property. The other, because this type of loan carries high interest, the lender also want to protect themselves. And then they are likely to actually impose a prepayment penalty. You can always buy it down and say that I don't want any prepayment penalty, then you pay it with a high interest rate. Otherwise, if you're willing to take a longer interest prepayment penalty period, anywhere from 1 to 3 years, then you have a slightly lower interest rate. Yeah.
Okay, so this is our final slide.
Yes. So I just want to basically mention some of the other non-QM, some of which we're familiar with, like on the right-hand side, non-warrantable condos. We've talked a bit about it, and then Jin has webinars, so we all know this topic pretty well. And so structural issue litigations, too few owner-occupied, and then not enough HOA reserve, all make this non-sellable, the loan non-sellable to Fannie and Freddie. So that's considered not the QM, non-QM. And then if you move to the left, and the next two are basically lender trying to say that I know interest rates high, it's hard to qualify. How about if I find a way to lower the interest, lower the monthly cost for you? Hopefully that would allow you to qualify. So that's where the 40-year loan come from, and then the interest only. And then as Elsie mentions, First Republic Bank used to do some of that. That's not QM loan. And then now that Chase has taken over, they said that, no, we're not going to do that anymore. So the leftmost one deals with the restrictions of like status citizenships. And these are primarily targeting foreign nationals, people who are here legally, but not permanent residents, not citizens, and not people on not H1 with employment authorizations. They generally have non-traditional credits or even no credit score. So there's a particular program that addresses that as well.
As you think about your business, you look at who are buying right now, I think this slide is going to help the most, in the sense that if you have clients who have a lot of appreciated stocks, help them think about asset depletion. Remind them not to rule themselves out for a loan just because they don't have current income. And same goes for people who have made a lot of money over the last 3 years in the stock market, young retired, starting their own company. We have several clients like that. You know, if they're self-employed, they don't have W-2, they may think that they don't qualify for a loan, but very often we can still find ways to help them qualify for a loan using asset depletion or alt-doc. And then just in general, keep in mind that if you're working with a bank or a big brokerage account, yes, they have private banking relationships, and that may be the best discount that that your clients can get, the best loans, lowest interest rate. When there is something a little bit unusual, they just had a job change, they just came off maternity leave, they have a lot of RSUs that have not, that they just got, they don't, it's complicated, then it's better to work with a mortgage broker who can combine different sources of income to help them qualify for that new loan.
So that's it. I hope you found the information helpful. And if you're in a situation where you might need their help, please be sure to reach out to Elsie and Eric, as I'll have their information in the description below. And be sure to subscribe to our channel and choose to get alerts whenever a new video is published. Thanks again for watching. And if you're planning to buy or sell real estate in the area, or if you know someone who is, please be sure to contact me, as I'd love to be your trusted real estate advisor. Have a great weekend.